Are your forex trades not working out the way you planned? Maybe you are making some of the most common trading mistakes without even realizing it. So in this video, I will walk you through the 10 most common forex trading mistakes and more importantly, how to avoid them. Trust me, understanding these pitfalls could be the game changer you need to take your trading to the next level. Before we dive into the video, my name is James Gides. You subscribe to the channel, smash the like button if you find value, and join our Telegram community. The link is right at the description. With that being said, let's jump into the video. Now, mistake number 1, trading without a plan. Trading without a plan is one of the biggest mistakes you can make in forex. Imagine trying to build a house without a blueprint. You do waste time, energy, and resources, and the results would likely collapse. The same goes for trading. Without a clear plan, right? You are just guessing, and guesswork rarely leads to consistent profits. A solid trading plan acts as your roadmap. It includes your goals, risk tolerance, and possibly specific criteria for entering and exiting trades. For example, instead of impulsively jumping into a trade without the price looks good, a plan helps you evaluate the setup logically and stick to your strategy. When I first started trading, really I skipped this step. The market doesn't reward impulsiveness, it rewards discipline and preparation. Take the time to craft a plan, right? And you will avoid unnecessary losses. Mistake number 2, over leveraging. Now, over leveraging is one of the quickest ways to blow your trading account. It's tempting to use high leverage when you are chasing big profits, right? Over leveraging is also a double-edged sword, right? While leverage amplifies your gains, it also magnifies your losses. I learned this the hard way. I took on a highly leveraged position thinking it was a sure thing. Small market reversal wiped out a significant portion of my accounts in a second. The solution is use leverage responsibly, stick to risking only 1 to 2% of your capital per trade, or even if you are using leverage. This way, you can withstand losses and stay in the game. Smash the like button. Mistake number 3, ignoring risk management. Ignoring risk management is like driving a car without brakes, right? It's only a matter of time before things go wrong. Many traders focus solely on potential profit and forget to protect their capital, right? Which is the foundation of long-term success in the forex industry. I will never forget a trade as a trader where I skipped setting a stop loss, right, thinking I could manually monitor it. A sudden market spike during a news event and wiped out a significant portion of my account before I could react. That losses was a tough lesson, but it taught me the importance of managing. And to avoid this kind of mistake, always set a stop loss and define how much you are willing to risk per trade. Proper risk management doesn't just protect your account, it gives you the confidence to trade consistently without fear or catastrophic losses. Now remember this. Now preserving your capital is the key to staying in the game. Now mistake number 4, letting emotions take over. Letting emotions take over in trading is a mistake that even seasoned traders struggled with. Like fear, greed, and frustration can cloud your judgment and lead to impulsive decisions that derail your strategy. I remember a trade where I let greed get better of me, right? The trade was already in profit, but instead of closing it as planned, I decided to hold on and open many positions again, convinced the price would keep going. I know you must have experienced this as a trader. Drop it at the comment section. The market turned against me and I ended up losing not just the profits but part of my capital too. The key to avoiding emotional trading is discipline. Stick to your trading plan, which I've said earlier, no matter how tempting it is to deviate, right? Take a break if you're feeling overwhelmed and remind yourself that losses are part of the game. Trading isn't about being right all the time, it's about making smart, calculated decisions consistently. Number 5, overtrading. Overtrading is a common mistake that can quickly drain your account and your confidence. It often happens when traders feel the need to always be in the market, chasing profits or trying to recover losses. I'm understood. But in Forex trading, less is often more, and I've fallen into this trap myself. There were days I took trade after trade thinking I'd eventually hit a big win. Instead, I ended up making emotional, poorly and thoughtful decisions and compounding my losses. Now think about this. Overtrading left me frustrated and exhausted doing nothing. Here is a solution. Be selective. Only trade high probability setups that align with your strategy. I'm understood. Set a daily or weekly limit on the number of trades you will take and stick to it. In Forex, remember quality over quantity. Patience and discipline often yield better results than constant activity. Number 6. Chasing the market is a mistake that happens when you jump into a trade impossibly after seeing a strong price movement, right? You may feel like you are missing out, but by chasing the market, you are essentially trying to catch a moving train, and that rarely ends well. I've done this before, seeing a price surge and rushing in without any strategy at all. It's easy to get caught up in the excitement, but this often leads to entering at unfavorable prices, only to see the market revise on you moments later. To avoid chasing the market, stick to your plan and wait for clear, well-defined entry points. Be patient and trust your strategy. Mistake number 7, ignoring fundamental analysis. Ignoring fundamental analysis is like sowing without checking the weather. You are at the mercy of unexpected storms, right? Many traders rely solely on technical charts, but economic events and news often drive the market in a way no chart pattern can ever predict. So I made this mistake early on. I was deep into a technical trade when the central bank announced a surprise interest rate decision. The market moved against me so fast and I didn't know what hit me. That loss taught me a critical lesson. Understanding the fundamental is essential. Pay attention to economic indicators like GDP, unemployment rate, and central bank policies. Use a Forex calendar to track upcoming events and plan your trade around high impact news releases. Combine technical and fundamental analysis gives you a well-rounded approach and helps you make more informed trading decision. Mistake number 8, trading without backtesting. Now, trading without backtesting is like flying a plane without practice. You are bound to crash. Many traders jump into live markets with untested strategies, hoping for the best. Unfortunately, hope isn't a strategy. Now, I learned this the hard way also when I tried a new indicator setup that seemed perfect in theory. Without testing it, right? I went live only to catch trade after trade fell miserably, right? The problem wasn't the markets, I'm understood. It was my lack of preparation, right? Backtesting allows you to see how your strategy performs under various market conditions. By using historical data, you can identify its strengths, weakness, and areas of improvement. Platforms like MetaTrader, Go Charting, TradingView make your backtesting very easy. Before risking real money, right? Test your strategy over at least 100 trades to ensure it's consistent and reliable. Backtesting not only improves your strategy, but also builds confidence, giving you a clear edge when trading live markets. Number 9, not keeping a trading journal. Not keeping a trading journal is like trying to improve your fitness without tracking your progress. You will struggle to identify what's working, what's not. Many traders keep this setup, thinking it's unnecessary, but it's one of the most powerful tools for growth. When I first started trading, I didn't bother recording my trades, right? I thought I do remember everything, but over time, the details got fuzzy, right? I kept repeating the same mistakes like overtrading or ignoring my plan without realizing it. But once I started keeping a journal, everything changed. Write down why you entered, your risk, and the outcome of the trade. Review it regularly to spot patterns and review your strategy. I'm understood. It doesn't have to be complicated, but just something simple and consistent. With a journal, you can turn every trade into a learning experience, making you more disciplined and confident trader. Mistake number 10, unrealistic expectations. Unrealistic expectations are a surefire way to set yourself up for disappointment in Forex trading. Many new traders think they can make huge profit overnight, fueled by stories of fast riches, but that is not how the market works. I remember when I first started trading, I was over ambitious, right? I set sky high profit goals, thinking I could double my account in a week. After few losses, I quickly realized how dangerous that mindset was. Successful trading comes from steady, consistent growth over time, right? Expecting huge returns on every trade leads to emotional decisions like overleveraging or chasing losses. Am I understood? Now, set a realistic, achievable goals, such as aiming for consistent weekly or monthly gains. Celebrate small wins and focus on building your account gradually. By keeping expectations grounded, right, we will reduce frustration and maintain the patience needed for long-term success in Forex. Remember, slow and steady wins the race. Now that you have known the common Forex trading mistakes and how to avoid them, if you found this video helpful, don't forget to smash the like button, subscribe, turn on the notification bell. And if you want to learn how to trade and become a profitable Forex trader, the link is also at the description. And if you're new to Forex, you need a broker, reliable brokers, the link is right at the description also with little spread. So see you in the next video.